Today, I'm going to give you an overview of over-the-counter products. Chapter 1, Structured Products. There are many kinds of OTC products, mainly bonds and structured products. In this chapter, I will introduce 3 common structured products, which are swaps, equity-linked notes, and accumulator. First of all, what is swap? A swap is a derivative contract through which two parties agree to exchange certain assets or cash flows at a certain time in the future. Currency swap, interest rate swap, and total return swap are typical examples of swap. A currency swap involves the exchange of one currency for the same in another currency. It refers to the exchange of principal between two currencies in general. If it is an interest rate swap, two parties are settled on a regular basis with the same stream of fund, while the payment is the interest rate difference between the fixed rate and the floating rate, or two different floating rates, specified in the contract. There is generally no exchange of principal. The last one is total return swap. One party makes payments based on a set rate, either fixed or variable, while the other party makes payments based on the return of an underlying asset, which includes both the income yield and capital gains. The underlying asset, called reference asset, is usually an equity index, loans or bonds. Let me give you an example of total return swap. The contract first determines a nominal principal, and then during the contract period, one party agrees to pay counterparty the total return of a corporate bond on a regular basis, and the counterparty agrees to pay back the cash flow at the current floating rate periodically. The London Interbank Offered Rate, for example 5%, is the common benchmark rate for floating interest rates. One of the most important characteristics of total return swap is that the total return receiver can enjoy the leverage effect. Since principal is not involved in the entire exchange process, it contains leverage effect. As for the total return receiver, this is equivalent to buying the underlying assets without paying principal, but only interest, and obtaining the corresponding cash flow. Investors can conduct speculation with a lower amount of capital. On the other hand, the total return payer can short the underlying assets. Although an investor is holding a risky asset, he may be subject to regulatory restrictions and hence cannot short the asset. If he becomes the total return payer, this is equivalent to shorting the asset and receiving a floating interest. It can also exempt the asset from price fluctuation or default risk. Investors should be aware of the following major risks of trading swap. Firstly, actual interest rate, exchange rate, or total return of the assets may not in line with expectations. Total return includes interest and capital gain or loss, which is not guaranteed to be positive. Secondly, swap may involve greater liquidity risk than trading in derivatives on an exchange because there is no right to close an open position unilaterally. It may be impossible to liquidate an existing position or to assess the value of the position. Thirdly, investor bears the credit risk of counterparty by entering into an swap. The transaction will generally constitute unsecured contractual obligations with the counterparty. In case of an insolvency of the counterparty, preferred liabilities will have priority over unsecured obligations on claiming of the principal. If investors invest in total return swaps, they should also pay attention to the following additional risks. Firstly, total return receiver has no direct right to the underlying asset. Entering into a swap is not the same as taking a position in the underlying asset. Total return receiver will not have any recourse under the transaction against the issuer of the underlying asset. Secondly, if the underlying asset defaults, the total return will most likely be negative. Then the receiver must compensate the negative rate of return to the total return payer in addition to the periodic payment of interest. Lastly, although total return receiver enjoys leverage effect, but it can amplify both returns and losses. They can earn a higher potential return than by direct investment. Instead, they may also suffer losses which are much higher than direct investment. Next is equity-linked note. It is a type of equity derivative embedded structured product targeting at the investors who wish to earn higher yield than normal time deposit. and are willing to take the risk of partial or total loss of investment, or the repayment may only be made in the form of underlying shares. Equity-linked note is traded in board lots and should be traded with at least one board lot. One board lot of equity-linked note is equal to one board lot of underlying share or its multiple. The term of equity-linked note range from 28 days to 2 years and they are denominated in HKD. Odd lots are settled in cash and transaction is carried out in a paperless fashion. Investors should be aware that equity-linked notes cannot be short sell. Investment return of ELI is commonly related with the performance of the underlying share. To provide better overall returns than common ELI, some issuer may introduce other features which may impose different impacts on the returns of ELI. Firstly, if ELI has early redemption feature and the closing price of the underlying shares, or the most underperformed share in the basket of shares on the redemption observation date, is equal to or higher than the redemption strike price, the ELI will be terminated early. Secondly, if the closing price of underlying share is equal or lower than the trigger price on the trigger observation date, the trigger event would occur. The trigger observation date may be a specified date, or a specified transaction day from the issue date to the scheduled final valuation date. A knockout option expires and becomes worthless if the price of an underlying asset crosses the predetermined threshold. As the profit opportunity is limited, barrier options such as these are sold cheaper than standard options. The last one is daily accrual basis. It is to keep investors aware of the daily price trend. The payout amount depends on the number of trading days on which the closing price of the underlying shares is equal to or higher than the coupon accrual price within the observation period. ELI with daily accrual feature may have more than one coupon accrual price. ELI may set with a higher coupon accrual price and a lower coupon accrual price at the same time. The closing price of the underlying shares could be higher than high coupon accrual price, or between the high and low coupon accrual price, or below the low coupon accrual price. As a result, the accrued interest will be different. In such cases, if the closing price of the underlying shares is lower than the coupon accrual price throughout the observation period, there may not be any accrued interest. Investing in the equity-linked note will expose you to certain risks. Investors are exposed to the risks of underlying stock price or market price fluctuation, the impact of dividend payout and corporate actions as well as counterparties risk. Investors should be prepared to receive the stock only or the value of the stock may be less than the investment amount when the note is due. If the underlying stock price goes opposite to what investors expect, investors may lose partial or even all of their investment. The ex-dividend price due to dividend payout may affect the price of the underlying stock, and in turn affect the payment when equity-linked note is due. The issuer may make adjustment to the note due to the corporate action carried out by the company of the underlying share. The yield of equity-linked note is commonly higher than that of traditional bonds or time deposit, but the only investment return is the yield of note. In addition, investors should make it clear with the broker about the fees incurred from the monies or stocks received when the note is due. Such fees are not included in the yield figures announced by the exchange. The last one is accumulator. It can be divided into accumulator contract and decumulator contract. Accumulator is a combination of a series of synthetic forward contracts which enable investors to buy or sell underlying securities at a fixed price at a fixed time point. The purchase price of accumulator is usually lower than the prevailing market price, whereas the sell price of decumulator is usually higher than the prevailing market price. Investors need to pay attention to the following three special terms. First, knockout feature. Both types of accumulator contracts can be embedded with the knockout clause, with the daily closing price as the trigger point. When the market price of the reference security is higher or lower than the knockout price at market close, the contract will be terminated. Second, leverage feature. When the market price of the reference security is lower or higher than the strike price, investors need to buy or sell the security at the strike price with the leverage multiple until the end of the contract. Third, guaranteed number of shares feature. If the knockout event triggers within the guaranteed period, investor can still buy or sell the guaranteed amount of securities at the exercise price. Investing in accumulator or decumulator will expose you to several risks. For example, you will face liquidity risk. As there is no secondary market for accumulation options, the exit cost is high. When the market is unfavorable, investors still have to buy or sell predetermined amount of securities at the strike price, which may lead to substantial loss. Investors will also face credit risks of issuer or counterparty. The potential leverage risk may amplify the extent of loss. Investors are also exposed to knockout risk by which their potential profit is capped. Investors of margin trading should be prepared to pay margin interest at any time, and to maintain sufficient margin level when a margin call occurs. The notice period of margin call could be very short. If investor does not pay the deposit in time, the contract position may be forced to close and a high closing fee will be charged. When the stock price is trading in the opposite side, investors will incur losses. In addition, investors are also exposed to settlement risks that counterparties may fail to fulfill their obligations of trading. Lastly, as the financial market is ever-changing, investors may earn returns or suffer losses from investment. Therefore, before making investment decision, investors should read the offering documents of related products carefully to make sure they fully understand the terms and conditions, product nature and the risks involved. In addition, investors can also consult investment advisor about all the information of characteristics and risk exposure of the products.